Any questions, concerns about last class? Okay, so we're going to go back to where we're pick up where we left off, dealing with contributions of property, and now we're going to deal with a more complicated issue, which is going to be where a contribution of encumbered property to the partnership. So that's where the property is subject to a liability that the partnership assumes. What are the consequences there? And we got a bunch of things going on. It's a pretty common fact pattern to have property being contributed to a partnership that has liabilities attached to it. So before we get into some of the statutes that are involved, I want to back up a little bit and talk some concepts, some theory. So the first thing is partnership tax is this blend of what people call aggregate theory and entity theory. So an aggregate theory is the idea that the partnership really doesn't even, there's no separate entity. So if I join together with another person to run a business, it's kind of like I'm just running half the business. So aggregate would treat me as just sort of doing half the things that the business does. In a very simple partnership, that would be aggregate. And the partnership is effectively transparent. It doesn't exist. Entity, on the other hand, gives respect to the fact that there is an entity there. And so partnership tax has this blend of aggregate and entity theory. So aggregate theory, it flows through taxation just generally is a core concept of an aggregate theory. Unlike, let's say, corporate tax, where the entity, the corporation actually pays tax. That would be a classic sort of entity approach. But in other respects, the partnership is given significance and is treated as an entity. So the example is that the partnership is required to file a tax return. If it was just pure aggregate, we wouldn't have the partnership file any return. And we're going to see certain things like elections, whether you use the cash method of accounting or the accrual method of accounting, that's done at the partnership level. So we have this blend of aggregate and entity theory. And sometimes the aggregate theory controls, I guess I would say sort of most of the time with the significant stuff. But with things like elections and other procedures, the entity theory controls. So that's one thing, and we'll come back to that time and time again. The other concept I want to talk about is just generally the role of debt in tax law. So when you have when you borrow, generally, we know that when you borrow, you don't have gross income when you borrow money because you have an obligation to repay it. But even though you don't have any gross income when you borrow money, you get basis. So in that respect, it kind of looks like you're getting sort of free basis. Normally, when you get basis, you earn $1, you pay tax, and now you have $1 basis in the dollar, but you paid the piper, you paid tax to get that dollar. So basis generally reflects after-tax dollars. Well, borrowing kind of turns that on its head, and so when you borrow money, so you just borrow cash, you have basis in the cash, even though you haven't paid any tax. And the idea is that eventually you will pay the tax because eventually you're going to have to earn money to pay them to pay the borrowing back. And when you repay borrowing, you don't get a deduction. So we kind of give you like advanced basis credit when you borrow money. So if you borrow money to buy property, let's say you buy a building for $1 million and borrow, debt finance it entirely. So you haven't put up $1 of your own money. You get $1 million of basis in that building. Again, on the theory that you will eventually repay the loan. And when you repay the loan, you're going to repay the loan with after-tax dollars. We could envision a system that's different, where we don't give you advanced credit for borrowing, where we say, okay, we're not going to give you basis in that building until you start to make principal payments on the loan. But we don't do that. We give you advanced credit, and that's generally taxpayer friendly because that basis then can give you depreciation deductions and other deductions earlier than you repay the dollars. And one last point on borrowing is going to be that this treatment of borrowing that I just described, it applies whether the loan is recourse or non-recourse. So a recourse loan is one where if you don't pay it back, the creditor can take any collateral, any property in which they have a security interest, and then if the property is insufficient to satisfy the debt, they can go after your other assets. They get the lender has recourse against your other assets. In that respect, that kind of, giving you basis credit for that kind of makes sense because you're gonna pay it back. Oh, and by the way, as we know from Tax 1, if you don't pay the loan back, you'll have COD income, generally cancellation of debt income. With non-recourse debt, it's a little bit harder to justify this treatment, this generous tax treatment, because a non-recourse loan is one where if you don't pay it back, if you default, the lender's only recourse is to foreclose on the collateral. And if the collateral is insufficient to satisfy the full amount of the debt, the lender eats it. The lender cannot sue you for a deficiency. So in a non-recourse situation, if you borrow on a non-recourse basis, you may never pay it back. If the property drops below the level of debt, you can just abandon the property and walk away and not have to pay it. But the tax law in a famous case called Crane concluded, used for the Supreme Court in a famous case called Crane, concluded that you get credit, the basis credit, whether the debt is recourse or non-recourse. So again, when you borrow the money to buy property, you get debt, you get basis for that debt, whether it's recourse or non-recourse. Okay, any questions about those background concepts? All right, well, let's turn to the code. So we've got section 752, the code. Let's turn there. We've seen this code provision before. So again, when the partnership borrows money, the partnership is going to get basis when it borrows money. Whether it can either borrow to get cash or it could borrow to buy property. Either way, it gets basis in that money or property. So that's inside basis. What 752A does is it will give the partners outside basis for that debt. And they're right here, there's any increase in the partner's share of liabilities of the partnership. Shall be considered a transfer of money to the partners by the partner to the partnership. So it's a deemed transfer of money. For tax purposes. We're going to talk a little bit in a little bit about how do you determine each partner's share of the liabilities, but in the aggregate, we can say that once the partnership borrows money, the partners in the aggregate, their outside bases are going to go up by the amount of money because it's a deemed contribution of money. And then once you have a deemed contribution of money, we go back to section 722. Well, we don't have to go back to it, we remember it, but 722 says that when you contribute money or property to a partnership, your outside basis goes up by the amount of money or property, by the basis of the money or the basis of the property. So again, if it's money, your outside basis will go up by the amount of money that you're deemed to contribute. And then let's look at 752B. So that's kind of a review. We did that last week. We haven't talked as much about 752B. The flip side is once your share of the liabilities goes down, then that's considered as a distribution of money. So we have a deemed distribution of money. So if the partnership pays off the debt or the debt is canceled, that's a reduction of the partnership liability. It's going to reduce the partner's aggregate shares of the liability. There are other ways it could go down. The share of liability could be shifted. So one partner could have a big share, and then for reasons we'll talk about, that could get shifted to another partner. So the one partner who's offloading the liability, his share is going down. and the partner who's getting more of the liability, his share is going up. But for whatever reason, if your share of the liability goes down, it's a distribution of money. And we haven't yet talked about distributions of money and what effect that has. And we talked a little bit about it. So when you distribute money, when their partnership distributes money to a partner, let's look at section 705 of the code. Remember, 705 is our basis, outside basis calculations. And it says you start with your 722 basis, and it goes up by these things, and it goes down here by distributions by the partnership. So distributions are going to cause your outside basis to go down, but then it has a cross-reference to 733 about exactly what that means. So that kicks us into 733. When we have this constructive distribution of money, that's going to cause our basis to go down. How much does it go down by? Let's turn to section 733. Section 733 of the code says pretty simply, in the case of a distribution by a partnership to a partner, other than in liquidation of a partner's interest, liquidation would mean this is a liquidating distribution. You're getting this property, cash property, and then you're out. You're no longer a partner. We'll talk a lot more about distributions. But if there's here where it's 752B, you're often going to be continuing as a partner. So the adjusted basis to such partner and his partnership interest shall be reduced, but not below zero, by the amount of any money distributed. That's actual money or deemed money. And then, of course, we also know, as we talked about last class, that you can't have negative basis. You can't have negative inside basis. You can't have negative outside basis. There's no such thing as negative basis. So we're going our lower threshold is zero. So because of that, what if we have distributions in excess of basis? In theory, that would take our basis down to negative, but we don't allow negative basis. So let's just turn to section 731, which tells us something else. 731A1. In the case of a distribution by a partnership to a partner, and again, that's an actual distribution or a constructive distribution, it says gain shall not be recognized to such partner. That's a general rule, except to the extent that any money exceeds the adjusted basis in such partner's interest in the partnership immediately before the distribution. So if our distribution would take our basis below zero, if negative basis were allowed, that amount is going to be gain recognized to the partner. And so bottom line is, for distributions of money, they reduce your outside basis, but not below zero. And any distribution in excess of your adjusted outside basis immediately before the distribution results in gain to the partner. And we can see now one reason why 752A is a taxpayer-friendly rule. Let's go back to 752A real quick. 752A gives you credit in your outside basis for partnership borrowings, your share of partnership borrowings. You like to have higher outside basis for a number of reasons that we'll discuss through the course. But one we just saw is that if you have more outside basis, then you can get distributions of money without recognizing gain. So let's say you have a 10 of outside basis before 752A. But 752A gives you an additional 40 of outside basis. So now your outside basis is 50. And let's say you're then distributed $20 of cash. Well, because of 752A, that cash distribution is not taxable. It reduces your outside basis from 50 to 30, but because it doesn't exceed your outside basis, you have no gain. So giving you more basis for partnership borrowings is a good thing. We've talked earlier that S corporations is another flow-through entity. And from the 10,000 foot in the air level, S corp subchapter S is similar to subchapter K, very similar in many major respects. One big difference is 752. There is no subchapter S corollary for 752. So in that example I just gave you, you have 10 of outside basis. The partnership borrows a bunch of money. Your share of that borrowing is 40. Then partnership takes some of that borrowing and distributes the cash to you, 20 of it. In the S Corp world, you have gain of 10 because your 20 of distribution exceeds your outside basis of 10. You get no outside basis, no basis in your S Corp shares for that partnership for that entity borrowing. And this is one reason why inevitably when you see significant amounts of real estate, they're going to be held in partnerships and not in S Corps. What's one feature of real estate business? It involves lots of debt. Debt both on the outset when you buy property, but another thing that real estate owners do, real estate investors do, is that when the real estate goes up in value, they can borrow against that appreciation, and then they'll distribute the cash to the partners. It's a debt finance distribution. And if you do a debt finance distribution in a partnership, it's generally going to be a tax-free event because of 72A. You get outside basis credit, and then you get the cash. That's good. Basis goes up and it goes down, but it doesn't hit the zero threshold. If you did the same thing, the debt finance distribution in an S Corp, you could very well run in a situation where the distribution is taxable. Now it all works out in the end. Over time, the same dollars will be taxed. So, but the time value of money is very significant. So in the partnership world, you wouldn't be taxed currently. In the S Corp world, you get taxed currently. You'd have sort of phantom tax, and then you'd have a phantom loss later on. So it would offset over time, leaving aside important things like time value of money and the character of gains and losses. And that'll be something we'll come back to time and time again. That was really fast and quick. Again, one thing that makes this class difficult is it's not a linear. There's no way to teach it in a linear way. It's all interconnected. So that's bad because it makes it confusing, but it's good in the sense that it eventually, hopefully, sort of coalesces in a way that makes everything understandable, better, more understandable later on. Okay, I'm going to stop and take any questions, comments, thoughts. Okay, so let's look at the problem on page 50. So you've got this problem here, and this is just we haven't yet done how do you determine the share of the partner's liabilities, and we're going to spend a whole class, actually 2 classes down the road on this question. So we just have to sort of generalize here, and then we'll come back to it in more detail later. But there, the rules are fleshed out in the regulations. Again, we'll spend a lot of time in those regulations. So we have here in A, B, C, and D each contribute $25,000 to the partnership. Each get back 1/4 interest in the partnership. The partnership then borrows another $900,000 on a non-recourse basis to buy $1 million building, using $900,000 of non-recourse debt and $100,000 of the cash. So we need to figure out the capital. Let's do capital accounts, and let's do outside basis. So we'll just do the balance sheet. So we start off really simply here, and we've got A, B, C, and D. further apart. And they've each got a capital account and an outside basis. And when they contribute the cash, that's really easy. Their capital accounts, as we know, based on the capital account maintenance rules, go up by the amount of cash contributed. And under 722, their outside basis goes up by the amount of cash contributed. Then they borrow the $900, so you put the debt up on the balance sheet. It's non-recourse debt. And then they end up with this building over here on the left side of the balance sheet. It has a book value and a basis of $1 million. So that's all well and good. But now we have to, once the partnership borrows the money, before the partnership borrows the money, each partner's share of the partnership liability is 0. After the partnership borrows the money, in the aggregate, their shares are going to be 900. So somebody, all partners or some partners or one partner, is going to get a total of 900 of outside basis adjustment under 752A. So we can put down here 752A plus 722 is going to cause the outside bases to go up, a deemed contribution of money. And the rules, how we share non-recourse liability, the rules and the regs, again, we're going to spend a lot of time on this down the road. But for now, we can just say when for sharing non-recourse liability, the rule is that they're shared in accordance with the partner's interest in profits. And here we have a very simple partnership. It's 1/4 each. They've got a 1/4 interest in profits and losses and everything. So we're going to divide that up, divided by 4, and each partner is going to be deemed to contribute $225 of cash. So they're going to get $225 of outside basis. And so at the end of the day, or immediately after this partnership acquires this building, the accounts are going to look like this. Each partner is going to have a capital account of 25 and outside basis of 250. We could do a check here too. We have to have our balance sheet has to balance for book purposes. So our book value of our assets has to equal the sum of our debt and our capital accounts. And it does. If it didn't, something's wrong. There's just no two ways about it. We made a mistake if it didn't. It can't not equal. Your balance sheet has to balance. Now for your tax, your basis, your tax values, if you will, your inside basis, here we can look and say our inside basis is 1,000 and our outside basis is 1,000. And that's usually the case that those will balance, but not necessarily. So if your inside basis and your outside basis don't balance, you didn't necessarily make a mistake. We'll see very shortly today a situation where outside basis and inside basis don't balance. But generally they do. That's the way it's supposed to work. But sometimes the rules aren't perfect and they get into some mismatch. Okay, any questions on that? That's the answer to A. In B, it's kind of a red herring. So in B, In A, they're all general partners. So in theory, they're responsible for the partnership debts, but because the debt is non-recourse, if you're a general partner, you're not liable for debts that the partnership's not liable for. And so when they're general partners, this is a rule. The red herring is, well, what if A is a general partner, it's a limited partnership, and the B, C, and D are limited partners? Does that change anything? The answer is no, not when it's non-recourse, because it's still a non-recourse debt. Yes, A is liable for partnership debts for which the partnership is liable, but the partnership is not liable for this debt personally or beyond just the obligation to deliver the property in the event of foreclosure. There's no personal responsibility. So the answer in B is the same as A. Where things change, now we'll go to C, things get more interesting. We're going to change this debt to a recourse debt. I want to say one other thing before we move there. So the mistake that students will make here is notice that we did not increase the capital accounts by the partner's share of the partnership debt. Okay, and so one thing, again, this will happen, even though I say it, I'll say it multiple times, at least one of you in the exam will make this mistake of increasing the capital accounts by the share of the partnership debt. One reason we know that can't be done, if this is why checking to make sure your balance sheet balances is a good check. If you did do that, your balance sheet would no longer balance. Remember, your book value is 1,000, your debt is 900. If you put another 900 in the capital accounts, the right side of your balance sheet would be 1,900, and so it wouldn't balance. So one is just, we know sort of just balance sheet mechanics, but I want to point you to a regulation. So I'll write this up because it's a long one. So you turn to this. It's 1.704-1 B2 4 little i's. Now remember, 4 little i's B was the basic rules that we learned about capital accounts, when they go up and when they go down. Right after B is C, and it tells us about liabilities, the role of liabilities. So let's turn to that regulation, 1.704-1 B2 4 little i's. (1.704-1 B2 4 little i's). So remember, these are our basic rules. B above, we saw these. This is what we went over last class. C goes on to talk about liabilities, treatment of liabilities. So it says, first of B2 4 little i's, this is a capital account maintenance rules. Money contributed by a partner to a partnership includes the amount of any partnership liabilities that are assumed by such partner. So if you assume a partnership liability, if there's a partnership liability and you say, I've got this, this is now my liability, my personal liability, then that's a deemed contribution of money. But that's not what's going on here. What's going on here is it's an increase in the partnership share of the debt under 752. That is not a deemed contribution of money for capital account purposes. So that's the authority for why we didn't increase A and B and C's and D's capital account by 225, even though we increased their outside basis by 225. Again, we'll do this lots of times in this class. This is the first time, but it's a common sort of foot fault that people make. And again, one way to protect against it is to periodically check to make sure your balance sheet balances for book purposes. Any questions on that? Okay, going back to C. So in C, we have the recourse debt. Now we've got the general partner. So for recourse debt, where there is a responsibility to pay beyond just giving over the collateral, the rule is, again, as we'll see in much more detail later on, is that the partners who bear the burden of repaying if the property went to zero. So let's say this property became worthless and the lender comes knocking on the door and saying, hey, you owe me $900. Because it's a recourse debt. And the partnership will say, well, we got nothing to pay, so partnership can't pay it. The LPs will say, well, we're limited partners under state law. We're not responsible for the partnership debts. And the GP is not going to be able to say that. So under C, the GP bears what's called the full economic risk of loss. So non-recourse debt is shared under 752 in accordance with their share of partnership profits. Recourse debt is shared in accordance with the partner's economic risk of loss, EROL, economic risk of loss. And here it's pretty simple that A is going to bear the full burden of the economic risk of loss. So A is going to get the full amount of the debt for 752 purposes. So A's share goes up by 900 from 0 to 900, 0 before the borrowing, 900 after. And B and C and D's shares stay at 0. So the books are going to look like this. Okay, any questions on that? And again, A's capital account doesn't go up. And if you want the citation for that, so when in an exam situation, I need you to support, what you're doing, explain to me what's going on. I don't need you to cite chapter and verse. Some students do. It's not a bad way to learn this stuff, to be very precise about authority for everything you're doing. And there's almost always a specific citation for almost every step of the way. And so if you wanted that, again, the citation is going to be this -1 B2 4 little i's. C is why you did not increase A's capital account, even though you increased A's outside basis. You increased A's outside basis because A's share of the liability went up by 900, constructive contribution of money. And then under 722, when you contribute money to a partnership, your outside basis goes up. So that's the citations for that. Okay, questions? Okay, so now we're going to turn to this contributions of encumbered property. So we're going to have a contribution of property that's either, if it's a recourse debt, the partnership is going to assume the debt. So the partnership will say, okay, I will be responsible for repaying the debt. If it's a non-recourse debt that is attached to the property, then the partnership is not going to assume it. There's no need to assume it. In that case, the partnership is going to take the property subject to the debt. The partnership is effectively going to be the one who is going to want to pay the debt, because to keep the property, they got to pay the debt. So again, the partnership is either going to assume the debt if it's recourse, or take the property subject to the debt if it's non-recourse. And when you have this contribution of encumbered property, it's useful to break down what's going on into 3 steps. One is we have the property contribution. And that's, the rules we've talked about already. 721, 722, 723, And for capital accounts, we've got the basic capital account rules. That was basically last class. The second thing that's good, and so that's the most obvious thing that's going on. The second thing that's going on is that the contributor is shedding individual liability. That liability that's attached to the property, because again, it's secured by the property, that's going off the contributor's books. It's no longer the contributor's debt. It's now the partnership's debt. So when the contributor is shedding the individual liability, we've got to deal with that. And then finally, since the partnership has debt that it didn't have before, the contribution, the partners, in the plural, share of liabilities goes up, right? Because it's new debt. When you got partnership has new debt didn't have before, that is going to create outside basis to the partners in some capacity. And for the contributor, we're going to see that this shedding of the debt in step 2 is going to reduce their outside basis. And then the contributor may get some or all of that debt back in step 3. So those are the steps we're going to take. It's really impossible to explain this anymore without the use of a problem. So let's take a look at the problem on page 50 of the textbook. Not 50, sorry, page 56. Right here, A and B, they're each contributing 30 of cash to the partnership. C is going to contribute land that's worth 60 and subject to a recourse debt of 30. It's a general partnership, they're equal general partners. And in A, we're going to start with the assumption that the land has a basis to C of 40,000. So one way to think about this is it could very well be that C borrowed 30,000 to buy the land, put another 10 of his own cash, and so that gives him a basis of 40 in the land, a debt of 30, secured by the land. And it makes sense that they're each 1/3 partners because each is contributing 30,000 of value. A and B are contributing 30,000 of cash. C is contributing land worth 60, but at the same time, it's burdened by this debt of 30, so the net value contributed is 30. So let's construct the balance sheet here, see what happens on this contribution by C. So A and B are really simple, at least to start. A and B are each contributing 30 of cash. So their capital accounts go up by 30 and their outside basis goes up by 30. We got cash on the left side of the balance sheet with a book value of 60 and a basis of 60. Then we got C. And the contribution of property, start out, his outside basis is going to be 40, because that's the basis of the land that he's contributing. The land is a fair market value of 60, so it's book value of 60, and inside basis of 40. And 723 is the rule that tells you that. And then we got debt up here that the partnership assumes 30 recourse. So that's pretty much all the simple stuff, I think. Right? There's nothing too tricky thus far. So one question we have to answer is going to be, okay, what is C's capital account? He's contributing property worth 60, and if we just stop there, his capital account would be 60. But he's also, on the other hand, shedding 30 of individual liabilities. And just economically, as we talked about earlier, he's only contributing 30 of stuff, 30 of net value to the partnership. If somebody gives you a house that's worth 60, but it's subject to a mortgage that you assume that's 30, they're not giving you 60, they're giving you 30. The net value, the equity, right? Concept of equity in property, the equity is the fair market value of the property above the liabilities that are attached to the property. So C is only giving 30 of equity. What do the capital account rules say? Let's go back to those capital account rules, the basic capital account maintenance rules. It's going to be 1.704-1 B2 4 little i's B. Let's go back to those basic capital account maintenance rules. So we looked at this last class, but we didn't focus on this part that I'm going to focus on now. So we said our capital accounts goes up, increased by amount of money contributed. And then it says the fair market value of property contributed by him to the partnership. That's where we stopped. We didn't consider the next clause. Net of liabilities, the partnership is considered to assume or take subject to. So if you contribute encumbered property to a partnership, you only get capital account for the equity that you contribute, the fair market value less the liabilities. So it's a little tricky here because, and I get it, because you don't make capital account adjustments, as we'll see down in C, down here, for shares of liability. But you do have capital account adjustments when the partnership assumes a debt, like it does here. And there's that distinction between basically 72A share of liability. It's like you're vicariously getting that share of the liability. Whereas here, it's actually just the partnership is assuming the debt. So anyway, regardless of that, you just have to kind of work with that in your mind and get that straight. But once you do that, once you look at that, what that tells you is the capital account that C gets is only 30. 60 fair market value minus 30 of debt assumed by the partnership. Okay, so that's the property contribution. Now we have to deal with the debt here. And so we have also, for tax purposes, let's go to 752B. 752B of the code. Let's go there. So we're going to look at another clause here. Let me get rid of this. We haven't looked at yet. Any decrease in a partner's share of the liabilities of a partnership, so we looked at that, or any decrease in a partner's individual liabilities by reason of the assumption by the partnership of such individual liabilities. So this constructive distribution, it occurs when the partnership liabilities go down, your share of the partnership liabilities go down, or when the partnership assumes your individual liabilities. And that's what's going on here, the latter. So here we have C's debt of 30 is becoming the partnership debt of 30. So under 72B, that's a constructive distribution of money to the partner by the partnership. So we have a constructive distribution of 30 by to C. And we know that distributions of money reduce outside basis by the amount of money distributed under section 733. So we combine 72B with 733, we reduce A's outside basis by 30. So we reduce it here by 30. Now we're not going to get into a negative situation. We don't have to worry about that. So that's the shedding of the liability. Constructive distribution of money. And then 733 makes that reduce outside basis. No gain on the distribution of money because there's enough outside basis to absorb it. But that, we're not done. That's step 2. Step 3 is now the partnership debt has gone up from 0 to 30. It was 0 before this transaction. Now it's 30. Now we have to apportion the debt among the partners. It's a recourse debt. And we ask again, if everything sort of went up in smoke, the creditor comes knocking, who bears the economic risk of loss? This is a pretty simple fact pattern. They're all general partners. They're all equal general partners. They're all contributed the same amount. They're all entitled to everything the same. So the economic risk of loss is going to be shared 1/3, 1/3, 1/3. And so their shares are each going to go up by 10. Under 72A and 722 combined, are going to cause the outside basis to each go up by 10. So at the end of the day, we have the following. Okay, let's check our balance sheet. Left side of the balance sheet is 120. Right side is 30, 60, 90, 120. So our balance sheet balances, that's good. And from a tax perspective, we also have balance. Our inside basis is 100 and our outside basis is 100. I'll mention one other thing and I'll stop. Recall we learned that 704C says that C, by contributing property with its built-in gain of 20, not recognizing that gain immediately because of section 721, but that 20 of gain is going to be traced, if you will, to C. That's 704C gain. So if that property of the land were sold the next day, let's run that through. What if the land is sold the next day? So they sell it for, somebody buys the land for 60 and they pay off the debt. So what would happen if they sell the land for 60, use 30 of the proceeds to pay the debt? When they sell the land for 60, there's no book gain because the book value is 60 and the amount realized is 60, but we'll have 20 of tax gain. And so under 704C, that's going to be taxed to C. So C is going to report the 20 of gain under 704C on this tax return. C's outside basis is going to go up. Under 705, we learned, and we'll talk about this many times over in the future, but when you get allocated gain, your outside basis goes up. So that's the sale of the property is going to trigger 20 of gain to C. The next thing that happens is the debt is going to come off the books because they're paying off the debt. The debt goes there, the land is gone, the cash is now 90. Now the partners share the liabilities is going down. It was 10 each, and now it's 0. So their shares of the liability go down by 10. That's a constructive distribution of money. Under 752B, and section 733 reduces the outside basis. So at the end right there, everything is in balance. We've got 30 and 30. If the partnership were then to liquidate by distributing the cash 30 to each, all the balances would end up at 0, which is where they're supposed to go. So this problem is really designed to get you here. That's really the important part. But I just wanted to tie it together with the idea that there is this 20 of 704C gain here that is going to be tied to C if and when the land is sold. Okay, questions on that? All right, well, let's skip ahead to part C, and we'll come back to B. In part C, the only thing we change, let me clean this up. I don't know how to clean this up easily. The only thing we change one little fact pattern. One little part of the fact pattern, 60. Again, in C, the land still has a basis of 40. Now the debt is 40 and it's non-recourse. Sorry, 30. So the bottom line here is that the answer is it's exactly the same. There is no change to the answers. Exactly the same. The only thing that's a little bit tricky that I would want to draw your attention to is just 752. C. Let's just turn real quick to section 72C. And if you look at 72A, actually, let's look at B. In B, again, the property is being contributed by C. C has no individual liabilities. It's just non-recourse debt. He gives the property to the partnership. Now the partnership takes the property subject to the debt. So if you look at 72B, you might conclude that C doesn't have to reduce his outside basis, because any decrease in a partner's individual liabilities, C may say, well, I have no individual liabilities. It's a non-recourse debt. But then 752C then comes in and says, for purposes of this section, 752, a liability to which property is subject, that's this non-recourse debt, shall be considered as a liability of the owner of the property. So that's what tells you that whether this debt is non-recourse or recourse, the adjustment to C's outside basis, a reduction of 30 to C's outside basis on 72B via step 2 of the analysis is going to happen. It says, well, for 72, we're going to treat that non-recourse debt as if it's the owner's liability. And then for capital accounting purposes, let's go back to the capital account rule, 1.704-1 B2 4 little i's B. Just to show you I'm not making stuff up, the same adjustment here, that remember that same clause, net of liabilities, that the partnership is considered to assume or take subject to. That's this language take subject to is what tells you that the capital account adjustments that we made, the capital account goes up by 60, but then down by 30 net. It's the same whether it's a liability, a recourse liability that's assumed, or whether it's a non-recourse liability that's merely taken subject to. So bottom line is for A and C, you get the same answer, even though the facts are different in the sense that the debt goes from recourse to non-recourse. Okay, questions, comments? I've been talking a lot. I know this is tough stuff. Sometimes I get comments that just, students are just trying to hang on. They don't know what to ask. I'm fine with slowing down. I'm fine with going over stuff. I'm never offended by questions or comments, but okay, so now we go to B. So in B, we change one fact. We're back to a recourse debt. Back to a recourse debt. So we change this. But now the land's value is only, the land's basis is only 10. So the basis is 10, but the debt attached to the land is 30. Some students might say, well, how can that happen? We talked about how when the basis is 40 and the debt is 30, it could be that the C borrowed the money. C borrowed the money to buy the land, and therefore, his basis includes the amount of the debt. So how could it be that the land's value is only, the land's basis is only 10, but the debt associated with the land is 30? Any thoughts? Or construct a hypothetical or how that could happen? How can your basis in the property be lower than the debt that's attached to the property? Two ways. Anybody want to take a guess?
Can't you refinance the property when it raises in value, even though maybe you own it for 10, but then it goes up to 30 and you refinance at 30, you're just borrowing money versus the property. You're not actually, there's no realization event.
Got it. You got it. So that's one. So one is you do a debt finance distribution like this. Basically, you're borrowing against the appreciation. So he could have bought this land free and clear for 10, let's say. Then it goes way up to 60, and the bank says, "Hey, that property is now worth 60. I'll happily lend you 30 against the land. It's a pretty safe loan for me." And you do it. So you borrow. It could be a second. You could have borrowed 10 to buy the land for 10. Then it goes up and you get a second mortgage. Take the 20 and do whatever you want with it. So that's one, where you're borrowing against appreciation. There's another way, not if it's land. I'll give you a hint. What if this were building and not land? How else could it be that we could have purchase money debt, but still the purchase money debt be larger, higher than the basis of the property? It's another way that can happen. That's a little more subtle, I think.
What if it were depreciating and he was adjusting his basis downward by deductions?
Yes. So that would be it. So if you have depreciable property that you're acquiring with debt, if the depreciation is faster than you're amortizing the principal payments, basically the basis is going down faster than the debt, then you get into the situation. You can get into the situation, and we're typically going to have like balloon payment debts. So like the debt is, so this debt of 30 is going to be, let's say, like a 10-year balloon payment. So it's owed, principal is owed in 10 years. And so in that case, again, if you, let's say you buy a building for 30 with a 10-year balloon note, and the purchase price is 30, so you're debt financing it entirely, then you're going to end up in a situation where the basis is going to drop below the level of debt because your basis is dropping and your debt is staying the same. So it's not going to happen here with land because land is not depreciable. So the only way this could happen is going to be the second mortgage type situation, of borrowing its depreciation. But if this were depreciable property, you could very well get into this because the depreciation is dropping the basis, whereas the principal is not dropping as fast. But for whatever reason, this is a situation we're in now, and now we've got this situation here again for C. So we don't change, this is the same, capital account still 30. We do change the outside basis, it was 40 and now it's 10 because our inside basis is 10. We still have that constructive distribution of 30 because he's still shedding 30 of individual liabilities. And then he's getting back 10, as they all are, here. So we have a situation now where your basis, we have a constructive distribution of 30 and then simultaneous constructive contribution of 10. So we didn't really have to worry about this before because we had plenty of outside basis. This was 40, which gave us plenty of room to maneuver. But now we have this situation where, how are these ordered? Does the contribution come first? Does this come first? Because that's going to tell us whether he has 20 of gain, because he's got 30 of distribution of money and only 10 of outside basis here. Or does it have 10 of gain, because we get to count this. So last reg we'll look at today, this is in the 752 regs, 1.752-1F. 1.72-1F. 1.72-1F. Right here. If, as a result of single transaction, a partner both incurs both an increase in the partner's share of the partnership liabilities or the partnership's individual liabilities, or a decrease in the share, only the net decrease is treated as a distribution of money, and only the net increase. So that tells us that we can net these together. We treat, we don't look at this as a distribution of 30 and then a contribution of 10. We look at it as simply a distribution of 20. So now we have this distribution of 20 to C, but he only has outside basis of 10. So distribution of 20 of money to C only has an outside basis of 10, so we can only reduce his outside basis by 10. It's kind of like combined here. Again, 1.72-1F doesn't assist here. So we distribute 20 to C, only has an outside basis of 10 before the distribution. So he reduces outside basis by the amount of money distributed, but not below 0. So C's outside basis is 0. Let's turn to 731 of the code. We've seen this before. This is, I didn't lie to you. I said that's the only reg we're going to look at today. Again, this is the code section. So let's look at 731A1. In the case of a distribution by a partnership to a partner, gains shall not be recognized to such partner except to the extent any money distributed exceeds the adjusted basis of such partner's interest in the partnership. Well, that happens here. We haven't seen it before, but now we have a distribution of 20 made to C, who has an outside basis of 10. So C has 10 of gain. So C now has 10 of gain. So C's got 10 of gain that he's going to report on his tax return. C is going to say, wait a second, I thought contributions of property to a partnership were tax-free. And he's right. It's not the contribution of property to the partnership that was the problem. It was the contribution, it was his shedding of 30 of liabilities, individual liabilities. He only got back 10 through 72A, combined with his very low basis in his property. So it wasn't really the contribution of property, it was the mechanics with the debt. So let's sum up and let's check. So balance sheet, book, let's look at book value of 120, debt of 30, capital accounts of 90. So that checks out our balance sheet balances. What about our inside basis and outside basis? Well, our inside basis is 70, and our outside basis is 80. Our inside basis and outside basis don't balance. We didn't do anything wrong, and that's okay. And it's not really elegant. It's not supposed to work this way. If we had negative basis, and conceptually, there's no problem with negative basis. And if we did have negative basis, then C would have negative 10 of basis and no gain. And we would have inside basis and outside basis balancing. So conceptually, that's really the right answer. We just don't have negative basis. The IRS has never got on board with that idea of having negative basis. And again, you could conceive of it where, let's say when he sells a partnership and he abandons it, he'll have 10 of gain, even though he has an out realized of 0 and a basis of negative 10. So, those of you who want to think about this, there's nothing really inherently logically wrong with negative basis. It's just an administrative decision that the IRS made that we're not going to allow this. So once we allow no negative basis, we have to have this gain. Otherwise, gain is going to leave the coop. And so then we end up with this inside basis, outside basis disparity. We're going to see later in the course that there's a code section 7, there's an election you can make under section 754 that's going to resolve, that's going to fix this. It's basically going to give some more inside basis. It's going to, but without absent an election, if there were no election, we just live with this imperfection, this conceptual imperfection, which is why, again, when you're doing this check, your balance sheet, your book balance sheet has to balance. That's just a truism, an absolute truth. Inside basis, outside basis, you can check that, but just because they don't doesn't mean you've done something wrong. You could be in a situation where it just happens. And then the last thing I want to talk about is going to be what could C do to fix this? So C, you represent C, and C says, you say, well, if you contribute this property under these facts, you are going to be have 10 of gain. And C, like most taxpayers, will say, well, I'd really rather not pay this gain now. I'd rather defer it. And again, this is kind of phantom gain. And so down the road, he's going to have phantom loss. I'm not going to run through it now. We've already done a lot and we'll come back to it. So it's really just a timing question for C. And most taxpayers will say, look, I'd rather not pay more tax now, even though it means I'm going to pay less tax later. Just strictly due to time value of money. So C says, is there any way we could avoid this problem? And so any thoughts as to how we fix this problem for C? He says, I don't want to pay tax this year. What's his problem? How do we solve this? Intrinsic, fundamentally, his problem is he's got too little outside basis, right? He just starts too low. So something that, you can say, well, I contribute more, contribute money, contribute more property with basis, right? You can jack that up. That's usually not a great idea because again, that's departing from the deal. C is, C puts more money in, then he's putting in more than the other folks are, and you got to presumably change the deal. So that's normally not attractive. The other way to work this is going to be, can you basically retain some of the debt or guarantee and indemnify A and B against some of the debt? So if he's able to get 20 of that debt, that's under 72A. Remember, on 72A, it's split 10, 10, 10. If it could be split 20, 5, and 5, then he'll have enough outside basis to absorb the the distribution. Basically, this outside basis will go down by 30 and then back up by 20, starts at 10. So, and the way he does that is he has to increase his economic risk of loss, and he has to increase his exposure. If the property, is worth 60 now, if it drops down below 30, he's no longer equal with A, B, and C on the debt, that he is taking more risk on. So this becomes a decision that, maybe he could save himself a tax problem. If he's confident the property is not going to drop below 30 or not drop very much below 30, then he can basically indemnify these other partners. Like, let's just say he says to A and B, he says, look, if you are ever called to pay any of this debt, I will indemnify you for half of whatever you're called to pay for. Well, if that's the case, then it's the last thing we'll do today. What happened then is now he's still shedding 30, but then he's getting back 20 because he's taken on 5 of A and B's exposure. And so now he's got a constructive distribution of 10, net of 10, but he's got basis of 10. He'd have no gain. And that solves C's problem. That solves his tax problem. That you have to worry about is you're the tax advisor, you have to say to C, this solves your tax problem. It may create down the road a non-tax problem, which is if the property does go down in value and the debt is now you're required to pay, you're going to now have to pay more than A, B, and C, A and B. And so C is going to have to make a business decision about whether the tax savings is worth the additional risk that he's taking on. Okay, any questions on that? All right, so I left off part D. We're going to just hold on that. We're going to come back to that one. That's where the same facts of 10 of basis, but the debt is now non-recourse. We'll come back to that later when we do this when we do this again. So bottom line here, this contribution encumbered property, we've done it once. We're going to do it again in a little bit more detail. It's a very common fact pattern. It's a common fact pattern that comes up on the exam. So make sure you work through this and get it eventually. Again, we have another big crack at it later on. Okay, we've run out of time. I'll see you on Wednesday.